Okay. Good afternoon, everybody. My name is Scott Kynes. I'm a director of Regency Mines, and I'm going to present our company overview this afternoon. At a high level, I first want to just talk about a little bit about what you get when you buy a Regency share today. We're offering exposure to a number of different opportunities here and a number of different commodities. So we sort of divide our exposure up this way. First into hydrocarbons, then into battery metals, which includes nickel, cobalt, niobium, and tantalum in our case. Then we have a technology section, which includes a division we've created called S-Tech and offers exposure to things like battery storage, battery technologies, and the like, and mining technologies. And then fundamentally, we're also a transactional business, one that looks to do joint ventures and to create value by doing disposals and asset sales. So when you buy a Regency share, you can expect to see these things manifested, and I'll go into more detail here as we go forward. This is our footprint. So, for a relatively small company, we offer a very global footprint. You can see you get exposure to things such as Papua New Guinea, nickel there, Motzfeldt in Greenland. We have metallurgical coal interests in the United States. We offer exposure to coal bed methane in Oregon. And as I mentioned earlier, we offer technology exposure, which can span the globe, but for the moment is focused mostly in Europe. So getting back to what I said earlier, there's a couple of strategic themes that kind of come through where Regency sits today. And I mentioned battery metals. I said we have a large nickel cobalt resource at Mambari in Papua New Guinea. And this feeds into trying to provide the metals that are going into cathode raw materials and the lithium ion batteries that are increasingly driving our world. At the same time, we're offering exposure to hydrocarbons, but not just traditional hydrocarbons. We think we're in the hydrocarbons that have a future. In this case, coal bed methane and natural gas. We think that natural gas is the winner in the US fossil fuel mix. It's the cleanest of the fossil fuels and the best one to be the bridge to renewables. On top of that, metallurgical coal. So we're not in thermal coal particularly. I mean, we're not in the coal that feeds power plants. We're in specialty high-value coal. So again, a hydrocarbon that we think has a future and is in the right place to be at this point in time. Lastly, battery technologies. As I said, we've set up a whole division, and I'll talk a little bit more detail about that, to focus on making investments in this space. But we think this is the future, and we think it sort of feeds together with what I've mentioned earlier with the battery metals and with the hydrocarbon play. And you can kind of see that here. I mean, we're offering exposure to what I have up here in light blue. So in Curzon, we're getting exposure to natural gas to sort of power generation. In the battery metal space with Mambari, we're offering the actual raw feed that goes into many of the batteries that are going to, like I said, increasingly power our devices and our world. And lastly, we've made investments in end use cases of these batteries. So you can see, if you buy a share of Regency, you're not just getting exposure to a narrow range here, but you're really getting exposure to the broad spectrum of both front end and back end of grid power and where these things are going. So I'll cover, first off, our mineral projects in a little bit more detail, and then I'll move into to the other ones I mentioned. So we've got a couple of metallurgical coal interests. The one we're focused on at the moment is this top one here, which we've announced an MOU and a JV with Legacy Hill Resources. This is to ultimately acquire what we hope will be a producing asset. Now, I can't say a great deal about this today, as this is a situation that's very much in progress, but I can say that news is expected in the near term, and that the basic plan is to get into producing assets, add size and scale to them, and then eventually roll that up into something that may be listed or may be appropriate for listing in the United States. And if you look at Warrior Coal, for example, you can find examples of other companies that have done a similar strategy to great effect. So we're very excited about this. This is probably our main focus at the moment. The timing of the show is probably a little bit unfortunate because we would like it to be a few weeks from now. We could probably tell you a great deal more, but all I can say is stay tuned. I know a lot of people have invested on this thesis in us, and I can assure you it will be realized. If you invested in Regency to get met coal production or exposure to that, you will get it, and you will get it hopefully sooner rather than later. So I'll just leave it at that for now. We do have an existing asset as well, which is a 20% interest in a small producing metallurgical coal asset in Alabama. This is part of our sort of efforts from last year. This has been a bit of a problem asset, to be blunt with you. The operational performance has been disappointing, and we're really looking for options here to either fix the problem in and of itself or potentially roll it into what I talked about earlier, which is a larger play. So we'll see how that plays out. This is our focus, like I said. We think met coal is the place to be. We think it's a coal, as I said on the right here, it's a coal that has a future. It fits well with with President Trump and his initiatives, infrastructure initiatives, making steel. We think this is a great place to be, and we think this is going to be the initial cash generative assets for Regency Mines, which is going to be a foundation of our growth. Moving on, so we do have a residual asset. This was a flagship asset for us for a long time, and we think it's coming back into focus now. This is a large lateritic nickel cobalt asset in Papua New Guinea. It's one of the largest assets in the world. Only 3% of it has really ever been tested, so it really has huge upside potential. We own it 50% alongside an Australian group that has a technology aspect to it. And we've been sitting on this for the last couple of years, having spent something around £8 million historically on it, waiting for the time to be right to bring it back into focus. And I think that time is now. If you're looking at nickel prices lately, they've become a lot stronger. And we think that the nickel plus cobalt story obviously is probably better than the nickel story was by itself a few years ago. So we've been kind of hinting that this was going to spin back up in the near term, and I think, again, be patient with us. We're not far away from having movement on this. We're in talks with our partner about whether they want to kind of come along for that journey or not, and you may see some movement one way or the other there. But for us, this is a key asset. A lot of money's been put into it, and we're all about unlocking that value for today's shareholders. So, watch this space is what I would say on that. Lastly, we hold one more mineral asset, Matsfeld, which is a multi-element project in Greenland. It has a historic JORC. It had a real big spend on it. We picked it up for almost nothing, and we've been sort of opportunistically kind of sitting on that, trying to either JV it out or find ways to take it forward into either production or expansion. It's a really interesting asset. The in-situ value is big. It's in a great location in southern Greenland, fairly easy to get to. And when you buy a Regency share, it's part of the mix you're getting access to is this as well. And so we're excited to see where this goes. Next up is oil and gas, so we offer exposure to that as well, as I mentioned. You can go, I won't spend too much time on Curzon here. They have a booth around the corner and gave a presentation earlier. If you're interested in learning more from them, you can talk to the CEO over there. But we were a pre-IPO and then an IPO investor in this business. We thought, again, natural gas is the fossil fuel to be in the United States. They picked up an asset out of bankruptcy that had 37 million plus spent on it. It had 5 wells already in existence, and they're going to drill 2 new ones. So kind of show that for you here. This is their plan. So those 5 black wells, those exist, and they're actually producing today. They're on sort of long-term test. The 2 wells at the bottom left in white are the 2 wells they're going to drill as part of phase 1. Beyond that, they have phase 2 and phase 3 planned, so if these wells do perform, you can really scale this project up and turn it into a moneymaker. So we thought the story was interesting, the fact to pick up something where you could be in production straight away. They hope to be in production, producing and selling gas here in the very near term. So for us, this has the chance to be, again, another cash-generative asset in our mix. A little bit about natural gas. I mean, I think the reason we like it, like I said, is that it's the fuel, I think, in the U.S. mix that's winning, that's sort of winning the battle. It's the one that I think is going to continue on and be the bridge fuel. CBM is a growing factor, I think, in the U.S. natural gas mix. It's something like 10% of production, and it's just kind of interesting from a historic point of view, I guess, that they've managed to turn something that used to be a miner's curse that caused a lot of deaths, and they're actually obviously turning it into a viable stream of energy at this point. So, from our point of view, we like the story, we like the company. You can go talk to them around the corner here, and I would suggest doing so when you get a second. These are the wells, or this is one of the wells actually. So we took this when we were out there last year. One of the advantages of the project is it has a major pipeline on it. You can see to the right there, that yellow strip marks that huge swath that's been cut through the forest. That's a major regional pipeline that goes right across the property, and that's in place. And it's part of why this is so attractive. It just doesn't take that much cost or that much effort to actually connect those 5 wells and any new ones they drill and sell gas, and that's what they're doing right now. So. It has a number of interesting angles. It's quite attractive. This is a typical pad which shows you what they inherited. So there's about five pads, 5 sites like this that they picked up and that we now have an interest in. Moving on. So this is STEC. This is our initiative over the last sort of 4 to 6 months where we have, obviously, as I mentioned, Mambare, something in the battery metal space, and we wanted to kind of broaden that exposure a little wider to get a technology aspect to it. So we created STEC. And so STEC really exists to explore opportunities in battery technologies. We already has, as we said, some exposure in the business to battery metals. We're looking at things in the grid services space and then potentially end use cases of batteries as well. So we've made one investment, which we've announced a few months ago, and that was in White Car Limited, which is really focused on being the sort of EV rental company of choice. I don't know if anybody's tried to rent a Tesla here in London of late, but it can be extremely expensive. I think Avis has one at Heathrow, and they rent it out for something like £500 a day or something ridiculous. So if you call up White Car, they'll bring the car to you, and they'll charge you one price, effectively. It's no insurance, upselling, and all the kind of games that the big companies play. It's designed to be a pleasant experience for people that want either a green rental car experience or or want to drive a new Tesla, depending on your interest in such things. So we invested, I think, at a key time. They were raising money to try to expand across Europe. They had opened a few sites here in the UK, and they really wanted to spread out and really try to scale up the business. So we put a bit of money in. Their sort of 5-year plan starts with Oslo, which is opening here in the next week or so, and then likely to expand across Europe. The focus, I think, is going to be Germany and Switzerland going forward. But what I'll point your attention to is the comparator on this and why we think this is exciting. A company called Silvercar grew in the US. They opened about 13 locations over 4 years. Very similar prospect. It's sort of one car. They only do Audi A4s. That's their shtick, and they're all silver, of course. They were bought out for, we don't really know, north of $350 million after 4 years. So if White Car's trying to do one thing, it's trying to replicate the silver car concept, but with EVs, which I think are even more probably the flavor of the day than silver Audis would be. So take a look at that if you get a second. I think it kind of shows some of the underlying thesis of why we thought this was attractive to our business. Beyond that, we're also, as I said, looking at a couple of grid storage-related entities. We're not talking a significant amount of money here, but again, we'd like to have S-Tech get exposure to a few things beyond White Car, and we'll make announcements in due course as those come good. But what I can say is that, these things all feed together. As I showed you earlier on that chart, we're trying to offer you buying a share of Regency a broad-based exposure to the battery metals revolution, and we think the pieces are coming into place to do that. So overall, we think we're in a good spot. It's been a little bit frustrating with some of the development, especially in the met coal story. We would fully admit that. Last year, I don't think went exactly how how we wanted it to. But the reality is, we're very excited. We think that these pieces are the right pieces, that the story is the right story, and that there's real upside in this share. So if you want exposure to battery metals, if you like our views on sort of what fossil fuels make sense to be in, and I think if you look at the White Car story and some of what S-Tech is doing, you can see how these pieces may all start to fit together. Then we could, we think the investment in Regency is a good one. We are focused on being cash generative, and that's where the met coal really comes in. I think a business like ours needs to make sure that it can self-fund largely, and the met coal should ultimately provide at least some of that puzzle. We are debt-free. We've paid off all of our corporate debt, so there's really nothing to be concerned with there. And as I said earlier, we think the foundations are here to offer you as the investor exposure to disruptions in the energy storage space, and so we'd like to see this really perform over the next 6 to 12 months. And that's really all I have for you. Our market cap is £4 million. We'd like to see it go north from there, as I already said. Sure. It's about 9%. Yeah, we're just under 9%, I think. So, yeah. And they're trading right around their IPO. So, it's still early days for them. If you saw the presentation that Thomas gave earlier, it's still early days. But I think what we thought was interesting is, like I said, it just doesn't cost very much to get into production. There's a lot of upside to it. And if they can get these wells to perform, you can really grow that thing. I would also expect, I don't want to speak for them, but you would expect them at some point to also look at other assets. So you kind of expect that business to grow. Yes. They got in on that story, yeah. So he's saying he got in on the Mets coal story. I know a lot of people did, and we're as sympathetic as we can be. That has not performed. I would say this. I think what we're looking at, what's being contemplated now is more exciting than what we were looking at last year. The risk last year, we were looking at brownfield projects and trying to restart them. The core of what's likely to come forward is existing production that has a track record. Again, I don't want to be too specific, but multi-year track record, 5, 6, 7 years of production. So to me, if you're going to do a roll-up, you want to build it on something meaningful like that, not have something where you have to put money in and return some things on and replace a lot of hardware and stuff like that. What we're looking at now, or what we're contemplating with our partners, Legacy Hill, is existing, efficient production, which you can then scale up. So, we're a small company. We're not going to go buy a £300 million asset, obviously. But you think about it, if you find the right foundation to that, you can really do some interesting things. It's not done till it's done, but I can just, without giving anything market sensitive today, it's en route. It's being worked. Sure. Mambari is an interesting one. I mean, what we've talked about earlier is trying to do something cheap and sort of get that restarted. We also want to flush out our partner. This is kind of what I was hitting at there. I mean, they need to sort of decide what they want to be. Do they want to develop this asset? Do they only want the technology to apply to it? So two things need to happen. We need to work with them and figure out what's going to happen there, and then start doing work on the ground again. I mean, frankly, the Papua New Guinea government has been very understanding the last couple of years. The market's been down. They understand that. But we're getting to the point now where they're going to want to see a little bit of work. We don't need to go spend $5 million or anything, but you need to do some work. So ground penetrating radar work is relatively cheap and may help us kind of expand the footprint of what we have. As I said, all the historic drilling was on the slope of this plateau, and that's not even the best target necessarily. It was just the most easily accessible. So if we can do some ground penetrating radar work on the flat of the plateau, that provides useful information that really makes the project more valuable. So this is a big focus of us. Well, two focuses: the met coal production and Mambari, really getting Mambari turned on, but in a sensible way. I mean, we don't want to do work just for work's sake, for obvious reasons. I mean, we don't want the government to drive the train. But I think, as I said earlier, it fits this story. It fits this battery metal narrative. The cobalt went from a product nobody was paying attention to what you might even call a co-product. I mean, nickel cobalt, that's a great story now. So we're gonna turn it back on. We're gonna do it in a sensible way, and we're gonna try to unlock that historic spend, so that we get that reflected in our evaluation. Well, just given the weather, soonish, yeah. So, yes. Okay. Yeah. Yes. Yes. Well, again, it gets back to my narrative earlier. I mean, if there was a mistake there, our partner in the UK, frankly, hadn't done a great deal of due diligence on that project last year. But what we've done this time, Legacy Hill, the projects that we're looking at, we have effectively diligenced these assets twice. That's kind of why it's taken.
I know where you're going. I'm kind of asking.
Yeah.
Who cocked up there?
Well, we're ultimately responsible as directors. There's no question. But what I would say is we are a minority stakeholder, so ultimately we weren't able to drive the train. I mean, our partner on the ground, our UK partner.
So would the major shareholder would have say?
We weren't the major shareholder. We were a 20%
shareholder in Regency never say.
We had influence but not control.
So who is the chairman here? CEO?
Yeah, Andrew's here. Yeah. I mean, maybe that's a conversation better for afterwards if you want to talk about it. Oh,
Okay, we have it now. What we recognized early on last year is that there was a good strategy, there were good assets, but the management that we were working with that had the majority was weak and needed to be supplemented. And we identified Legacy Hill, brought them in, friends of ours, people who were sharing an office with us, and we've worked with them since. So this is a continuation of that strategy, but we had to go backwards in order to go forwards. And the reason it's taken a year is because of the very careful due diligence that was done.
How was it done before? A lot of money spent.
Because we are now coming in as co-principals.
Yeah.
That makes a difference.
Our stake is going to be much closer to 50% at this point, so it's just a different ballgame. I mean, when you're a minority partner, we only have so much influence. I mean, that is what it was. You can either walk away, or you can try to fix the problem. We have been trying to fix the problem.
Yeah, I mean, America is full of people who tried to make money out of coal and have failed. And what we now have is a very good team, and an asset we're looking at that has run profitably for 8 years. In other words, through the worst parts of the coal recession. Sure, did we make the mistakes of apprentices last year? Yes, we identified an opportunity, we were getting into it. It takes time to go into a new market and learn about how to do things. You can't expect instant success, and we didn't have it. What we did, which is different, is we persisted. The same thing happened with some of our other ventures, this company and other companies. We didn't succeed at first, we made it work in the end.
People who are on a massive loss that at the end of the day, I have a big confidence in you. No confidence for running the operation. I really do not believe you.
Well, that's your prerogative.
I know how much money this company.
Yes.
Over the year. So I'm just to say what I feel.
Yes.
You feel completely.
Well, what has happened is a lot of investors who came in at around this price. Some people came in at higher prices, including a few who came in at twice the price. Because the price is down now, and as we say, we're about to announce things, you can't say that we have gone through a cycle, that we have abandoned an unsuccessful investment. It is still a work in progress. The only thing that I will admit is that there's been a long period in which we have not been able to give news. But as we've tried to explain, as Scott has tried to explain, that is because behind the scenes things are being negotiated, due diligence is being done, and we cannot make announcements that would be appropriate for a listed company on AIM until we can announce things that are certain. We will do that. What you can do is you can come back to us once we've made the announcements we're going to make and say whether you're satisfied or still dissatisfied.
To be honest, at this moment, I have no confidence in you. And everybody I know, actually out there, have no confidence in you and this issue. Maybe we need somebody new to run.
You're entitled to your
I
view.
don't know if anybody disagree with me.
We're over the time.
Thank you.